Hi, this is Mr. Evans. In this video, I'm going to summarise as quickly as I can. I'm going to try and do it in 5 minutes. The finance unit in GCSE. So let me start my timer. It's about to start. Here we go. Okay, so finance is assessed in paper 2. What is finance? Well, finance is the functional area in a business responsible for making sure a business has enough money for it to survive in the short and the long term, basically. First of all, a business might need to acquire sources of finance when it starts up, or when it's going along, it might want to do a project and get some extra finance. Businesses can raise finance from internal or external sources of finance. Generally, internal sources of finance come from inside the business, and external sources of finance are provided from people outside the business. Internal sources of finance won't have to be repaid. External sources may have to be repaid. Each source of finance has its own pros and cons, which you need to be aware of. But the other crucial thing, is that each source of finance is suitable for some business scenarios and not others. I'll give you an example. Businesses, if they are choosing to expand, might use debt finance, where they borrow money from a bank or in the form of a mortgage. Debt finance is good because the repayments are agreed in advance, the ownership of the business is not compromised, and the funds are provided for a specific purpose. But the debt must be repaid with interest. An alternative thing that a business can do is to raise equity finance. That phrase isn't in the specification, but it basically means selling shares, which is in the specification. Right? When you sell shares in a business, you effectively sell the ownership of the business. Okay, that's good because the money doesn't need to be paid back. Once shareholders have invested, that money doesn't need to go back to them. You might gain expertise, but because shareholders are investing in the company, they get a legal right to make decisions, so it can dilute the power of current owners. So there's some advantages and disadvantages of different sources of finance. Cash flow. This is the movement of money into and out of a business over time. Cash flow is very different to profit. A profitable business can fail if it runs out of cash, so this is a crucial topic. I'll give you an example. Rita is a wedding caterer. Her client pays her £12,000 and insists on paying 3 instalments of £4,000. Rita's costs are £9,000 in ingredients and staff wages, which are paid immediately. Well, if you have a look at Rita's profit, that's great. She got 12,000 in, but she pays out 9,000. However, the issue comes here, where they're going to pay in 3 instalments, but staff and ingredients need to be paid immediately. So let's just say it's a nice June wedding. Rita doesn't have any money in the bank. The payments, the inflows, are spread over 4 months, but all of the outflows go out in the first month. So what does that do to Rita's cash flow? Well, in the first month, she gets 4,000 in, she spends 9,000, she's got less than 5,000. She's got minus 5,000 in the bank at the end of the month, right? That carries on into July, where she gets another 4,000. So at the end of July, she's still minus 1,000 in the bank, and at the beginning of August, that balance is carried. So the difference between cash flow and profit is you can be profitable, but you can run out of cash, as Rita has in June and July, and that's all because of when the timing of the payments. So this is why a cash flow forecast is useful. It tells you when money will be coming in and when money will be leaving a business, and you can look at the closing balance, and if you've got a bracket there which indicates a minus sign, you might want to do something to make sure you get more money in. So there are various issues that can come when you don't have enough money to fund your business. So what are the solutions to cash flow problems? Well, these are all on the spec. I would maybe pause this and have a read. But basically, you can either get more money in or spend less money. These will all have advantages and disadvantages. So there's a few key terms and formulas that you need to know. You need to know what total revenue is and how to calculate it. You need to know the difference between fixed and variable costs, and you need to know that those added together make total costs. Okay, you might often see it put together in a table like this, where you're given the fixed costs, the variable costs, and the selling price, and you can use this to calculate a company's break-even output. Okay, where you put all of these, this is what it looks like. This point here is crucial because at this point the sales revenue is equal to the total costs. If we sell less units than 2,000, our total costs are higher than our sales revenue, and that's not good. That means we're making a loss. Once we sell 2,000 units, the costs are equal to the revenue, so we break even. Anything above that and we start to make a profit. This business is expecting to sell 3,000 units. Okay, that gives them a margin of safety of 1,000. There's 5 minutes. I've not succeeded. That gives them a margin of safety of 1,000 units. That means if they sell 500 less than they're intending, they're still making profit on 500 units. So there are a couple of definitions for you there. Profit is really important. It occurs when total revenue equals total cost, and we start to make a profit after we've exceeded the break-even output. Break-even has some strengths and some weaknesses to it. The main weaknesses of break-even is it's overly simplistic. It doesn't consider the fact that you might need to cut your selling price, for example, to sell more, or if you sell more, you might be able to negotiate cheaper prices with your suppliers. So businesses undertake investment. Investment in new buildings, new machinery, new vehicles. How do they decide whether to do it? Well, they might conduct an average rate of return. In this example, the business spends 500 million today. It gets these inflows and these outflows over 3 years. That means they make a total of 127.5 million profit over the time. Should they do this project? Well, they might want to calculate the average rate of return. We've calculated the profit over the lifetime of the project. These are the 3 steps to calculate ARR. You first of all calculate profit. You then divide it by the lifetime of the project to give you the average return per year, the average profit per year. So because this £500 million investment is going to earn profits over the 3 years, we divide that 127.5 by 3. That gives us 42.5 million a year on average. We divide that by the original cost of the project, because if we're going to invest 500 million today, we want to know what the average return will be. The average return will be 8.5%. So for every £1 we invest in this project, we're going to get 8.5 pence back per year. Is that a good investment? Well, you compare that to the average interest rate of maybe 1% maximum. You might decide that this is a project that your business should do. There are 2 financial statements that you need to be aware of. These are a legal requirement for public and private limited company to publish their financial statements. The first one is the income statement, right? The income statement answers the question, how much money did the business earn in a time period, typically 1 year? How much money did you earn last year? It's laid out like this. You'll get the revenue, then you get the cost of sales taken off in brackets. 100 minus 60 equals 40. That gives you your gross profit. You need to know how to calculate gross profit. It's right there for you. 40 minus 20. Remember, we've taken off our variable costs. We need to take off our fixed costs, also known as expenses. That gives us our net profit. Okay, and you can see how that's laid out there. Make sure you know the layout of the income statement. There's a difference between profit and profitability. A profit is the monetary figure stating how much revenue exceeded costs by. Profitability is a measure of how efficient a business is at turning the revenue collected into profit. You need to know how to calculate the gross profit margin and the net profit margin. But let's just have a look at an example here. We've got business A and business B. Business A makes revenue of £950,000, makes profit of £100,000. Business B earns lower revenue and lower profits, as you would expect. But which company would be better to invest in? Well, we could measure the efficiency with which the business is turning its revenue into profit. It's unfair to compare the profit figures because these businesses are different sizes. So what do? Business A earns 100,000 on sales of 950,000. It's turning 10.5% using this formula here into profit. So for every £1 they take in revenue, they're turning 10.5p into profit. Well, you do the same formula, there should be a times 100 there for business B. You'll see that they're earning, for every £1 they generate in revenue, they're turning 20p into profit. That means they're more efficient at controlling their costs, basically, than business A. You need to know gross and net profit margins. Statement of financial performance is the other financial statement document that you need to be aware of. This question, so the income statement says how much money did you earn last year. The statement of financial performance shows the net worth of a business at a given point in time, balancing the assets, like if a business owns a van, tools, cash, with the liabilities it owes. Okay, so loans, any trade credit or anything like that. And instead of looking at a year, it's a snapshot. So you take a picture of a business today, how much do we have in assets, how much do we have in liabilities, and therefore how much is our business worth. Here's how it's laid out. You look at the business's non-current assets. These are the things that are going to be used to generate cash for the business, generate income for the business for more than 1 year, like a factory, a van, a machinery, etc. You then, the next section is about current assets and current liabilities. Current assets are going to be turned into cash in the next 12 months. Okay, typically stock, any debt the business has to collect from customers, and cash. The current liabilities are money that the business is going to owe within the next 12 months. Okay, you subtract your assets, your current assets, from your liabilities. That gives you your net current assets. In this case, it looks like the business is in good shape for the next 12 months because they're going to get 40 million coming in. They're spending 35 million, which gives them net current assets of 5 million. If this is negative, that is a worrying sign for a business because it means they've got more money leaving than they have got coming in. This business also has long-term debts of 25 million. So what do we do with these? 100 plus 40 equals 140, minus 35 equals 105. We don't need to add this in because we've already accounted for that here. And then we take off, we've got 105. The business owes banks 25 million in long-term debts. That gives us 80 million in net assets. That's how much the business is worth. Where's that money come from? Well, it's come from share capital and retained profit. And this shows us what the business owns, its net worth, and where that money has come from.